Futures and options can be categorized under the derivatives classification for financial instruments. The derivatives were in operation for hundreds of years and have become significantly more popular during recent times. This is in spite of the fact they continue to face a lot of critique, with accusations that they cause the markets to be susceptible to lack of stability because of insufficient transparency. One of the main advantages of investing in futures and options would be that the risks management is improved, and while doing so liquidity levels will be increased. Values for futures and options will depend on an additional asset, and this is called the underlying. In general, this could be a stock or perhaps the market index. The option will be a derivative which gives a person the right to sell or buy the underlying investment. There will be no accountability. There are two forms of options, the put option and the call option. Call options will give an investor the authority to buy the investment, while the put option will be vested along with the right to sell this underlying asset. A mutual agreement is involved, and this is called the option contract, which shows the price for selling and buying the underlying asset. This option contract likewise provides the expiration date when the agreement will not be valid. It is possible to exercise options in the European and American styles. For the American style, an option is often exercised prior to the expiry of the agreement, while with the European style options could be exercised throughout the expiration date. Futures make reference to a tradable and standardized contract which will take settlement at specific rates and on specific date ranges. Futures will be more risky when compared to options since it carries a responsibility to buy. It is also possible to use commodities such as crude oil and gold in order to settle a transaction. Buying and selling in futures could be carried out in several ways. There is the squaring off approach, meaning taking the reverse option of the contract. Delivery option is when the asset will be delivered physically. For instance, if your guide involved selling a certain amount of gold, the real gold will be given to the buyer on the agreed date. Cash settlement will involve paying the difference of the spot price and futures based on cash terms. The futures trading guide will be extremely important to anyone since it will help with the understanding of the trading rules, because when it comes to futures trading it is possible to get a profit according to the speculation of price movements.